You're welcome to the Economy and Politics Show. I'm Ottoabasi Abasiekong. This edition will discuss monetary policy options for stabilizing the Naira. And joining us virtually is Dr. Ayo Teriba, CEO of Economic Associates. It's nice to have you once again on the program, Doctor.
Thank you very much, Otto.
Thank you. Let us begin with the reality that in the last 6 months, we have seen significant efforts by the central bank to address the challenges, complemented by the Monetary Policy Committee in terms of inflation and stabilizing the foreign exchange markets. Despite these steps, the situation remains unabated. And I'm asking, what are the lessons learned so far from these developments?
Well, we should commend the efforts of the Central Bank of Nigeria in the past 6 months in moving towards a more transparent regime in which the whole world knows what is happening in the markets, a more inclusive regime in which all players have a seat on the table, including BDCs, the currency, where the international currency transfer agencies, everyone that need to be in the market and in the market, and at least we have convergence, which the gap between the NIFEX and the EDC has narrowed. And the difference could today the BDC might be slightly below the NIFEX, and tomorrow NIFEX might be slightly below the BDC. So we have convergence. These achievements need to be kept. So they are worth, commendation. So everybody, there's great transparency and a lot of efforts, a lot of circulars. And since February, the Monetary Policy Committee had announced a series of tightening measures, including, the cumulative increase in the monetary policy rate by 600 basis points. CRR now stands at 45% from 32.5 before the tightening began. And the loan deposit ratio has also reduced from 5. And these all seem to have produced some initial gains. For the next 1 month, it had seemed that the tightening worked, that the exchange rate was beginning to strengthen. I had some analysts speak about 45% appreciation in currency, since the intervention. But sadly, for all of us, we have seen all those initial gains being reversed. And the exchange rate is pretty much back to where it was before the tightening began in February. Inflation is much worse now than it was in February. And compared to 6 months ago, we reference the date of the CIBN speech of the governor. Rates and inflation are worse than they were 6 months ago. They're the same as they were 3 months ago on the eve of the rate tightening by the MPC. So what do we learn from this? We learn essentially that there's a limit to which you can rely on administrative interventions to achieve monetary policy objectives. The consensus in contemporary macroeconomics, in which they speak about the macroeconomic policy trilemma involving exchange rate flexibility, capital mobility, and monetary policy autonomy. That you can't combine those things. You can only have two of those things. So for you to have monetary policy autonomy, you should freeze either exchange rate, you fix either exchange rate, or close your capital account. But if you have flexible exchange rate in which the exchange rate is volatile, and if you have capital mobility in which capital flows freely, you cannot have an autonomous monetary policy. You can't expect domestic policy instruments to be effective. I think that's the major lesson that we have learned the last 3 months. That it is futile to tighten monetary policy instruments in the face of exchange rate volatility and volatile capital flows. That the place to start is you can't fix exchange rates. A previous regime in the central bank tried, and it ended with multiple exchange rates on their hands. We have solved the problem of multiple exchange rates. So I'm not making a case for us pegging the exchange rates, but I am making a case for us treating the reserve inadequacy as the first problem to solve. The way other countries around the world resolve the impossible trinity, where the trilemma, they say, defines an impossible trinity, is to build up reserves in excess of possible, capital flows, such that exchange rate will be stable behind that wall of reserves. That's what China does. That's what Saudi does. Your exchange rate can be the same for 2 decades if you keep reserves in excess of your requirement, of your payments requirement, of your precautionary requirement, and of your speculatory requirements. That's what most countries in Asia, Latin America, most developing countries do. And that's how they can regain control of their monetary policy. So I do think Nigerian government is not treating the reserve inadequacy with the urgency that it deserves. They carry on as if, you can, use monetary policy instruments regardless of the situation with reserves. And the lesson we have learned is that it is futile to be fiddling around with domestic monetary policy instruments in the face of inadequate reserves. That you should do all you can as a matter of emergency to build up reserves. I do not think I can't see us making any efforts to build up reserves, much less, make enough efforts. Countries act in desperation. This is like you are being invaded externally. In the face of external invasion, you can't be talking of domestic peace. So ignoring, capital mobility is like Ukraine being invaded by Russia, and then, trying to maintain domestic peace. You can't have peace in the face of external invasion. So Ukraine travels all over the world looking for reserves, arms reserves to cope with the invasion. That's what we should be doing. The kind of desperation with which Saudi Arabia has been looking for investment, announcing 200 projects in the past, 9 years. The kind of desperation which is there has been, building up projects, looking for investment. Nigeria is not showing that kind of desperation. We have more than enough assets. We have more assets than Saudi to use to, attract foreign investment with which you can build up our reserves in the real estate space, in the infrastructure space, in the corporate space.
Yeah, so Doctor, let me come in here. So from what you've highlighted, you've talked about the fact that we are tinkering with our domestic monetary policy when we are facing external volatilities. So what do you recommend as the way forward now as we look at the challenges around monetary policy?
In the face of external volatility, domestic monetary policy instruments will not be effective. They will impose costs on the economy. They are going to hurt growth. They are going to hurt investment. Investors have to borrow to invest. I'm talking about direct investors. They have to borrow to invest, and there is an inverse relationship between investment and interest rates. So when central bank raises interest rates, they are hurting investments. Some say they will attract portfolio funds. Portfolio funds are not investment. They're savings. The day they arrive, you are sure that one day they will leave. So they're savings. You are just using investment as a loose form when you say portfolio investment. It's not investments, portfolio savings. But investment are sunk money, sunk investment, irreversible investment. They arrive and you know they've been sunk, they will never leave. If those who made that investment, domestic direct investment, foreign direct investment, all the factories that domestic direct investors have built are sunk, they are irreversible.
Yes.
If the companies that have made them want to exit, they look for somebody to buy them out. But those investments will be in Nigeria forever. They can't pull out the factories. So whether foreign or domestic, that's the kind of investors you should be trying to encourage. But these are exactly the ones that central bank encourages when they raise rates. And you are trying to encourage those who come and deposit money in banks, in treasury bills, or in stock market for nominal returns. And they will leave. You are sure that they are going to leave because they don't sink their money anywhere. So they make reversible savings. So you are encouraging the reversible savers, but you are hurting investors who make irreversible commitments to the country. So those costs are huge. So we have hurt those people since central bank began tightening 3 months ago for no benefit whatsoever to inflation or to exchange rate. It's not going to benefit inflation as long as the exchange rate has gone back to where it was before the tightening began. So we do have a trilemma. And to resolve that trilemma, you need to regain monetary policy autonomy by trying to. So what do you do? There's only one thing you can do that is reasonable: build up reserves. Basically, look for one asset or the other to offer investors. You have idle real estate, you have federal secretariats, you have those barracks, that are urban slums that could be redeveloped, regenerated into, cash cows for the country, which you can, encourage developers to come in and generate foreign investment. You have big companies that you can take to the market and raise investment. This doesn't have to take 6 months for you to consummate if you really, really determined that you wanted to do it.
Very important. Doctor, today is the big day. The Central Bank Monetary Policy Committee will be meeting, and we are seeing a steady rise in inflation. What do you recommend that is done today as they decide on the monetary policy rate?
Well, to the extent that the Monetary Policy Committee of the Central Bank of Nigeria have access to information that the rest of us don't. I am not here to make any recommendations there.
Yeah.
But what I'd like to say is that, well, at the end of their deliberations, they will reveal some of what they know that will inform, whatever decision they can take. But I do think that it will be futile to embark on further tightening. And the problem to be solved, I don't think is a monetary policy committee issue. if it is if the problem that is rendering their instruments ineffective have to do with reserve inadequacy, then you are hoping that there will be a whole of government response, including, the presidency, the economic agencies, the economic ministries, the coordinating minister for the economy, and the central bank, to ensure, the building is on fire. You can't be asking what the right thing the person in flat 1 will do or what the person in flat 2 will do.
Yeah.
The whole building have to try and put out the fire first.
Yes.
Before each person can then turn back to living their own life. So the Central Bank of Nigeria, the Monetary Policy Committee, has no life to live if the reserve situation is not resolved. It's a message that should have been clear to the government since May last year, before we started these reforms at all, that you should have set our house in order about reserves from day one. We neglected to do so, and we've suffered what we've suffered in terms of exchange rate volatility for 1 year because of that. I do hope that we take the lessons to heart and now set our house in order. Get adequate reserves. You can't be doing tightening in spite of low reserves. You won't get results. So fix the problem of low reserves, and we can do tightening. Deploy your sovereign powers to get reserves, and then everybody can go back to business as usual.
Yeah. Thank you very much, Dr. Ayo Teriba, CEO Economic Associates. You've just anchored that there's need for government and the monetary authorities working with the fiscal authorities. It's time to really hit the nail on the head, and that is exploring every way to boost our reserves, because a reserve adequacy will give us stability. Now is the time, and I believe that that's the key message as we navigate this socioeconomic phase. Thank you once again for the time, Doctor. I will say an apostle of financialization and unlocking value from our assets. Thank you for the time, and we look forward to more conversations around economic issues as we continue.
Thank you very much.
Thank you.
Thank you.
To our viewers, if you want to get further insights on this very interesting conversation, visit the ProShare website displayed on the screen and follow our social media platforms to engage further on this show. To become your way again, enrich yourself with the knowledge of socioeconomic developments around you, because it is a wise thing to do. I'm Ottoabasi Abasiekong. Thank you for watching, and bye for now.